My highest targets on XRP still stand, as Scalper did update these levels earlier today in the Discord. Still stand at $4.44 to $5.17 as my highest 2025 targets for XRP. So in today's video breakdown, we're going to thoroughly go over the landscape this week, take a look back at why the markets rallied last week, what the markets were pricing in, how that continued over the weekend, where we're currently at now, and what we need to be mindful of and paying attention to this upcoming week, as we have a huge data week this week, not only in terms of scheduled data, but we also have a lot of reactive headlines to be mindful of and focused on. So lots of scenarios that we're going to cover and walk through today. At the end of this fundamental breakdown, we are going to leave off with some of my forward-looking projections with the inflation data that we're going to get tomorrow. So I'm going to walk through some if-then scenarios, bearish case scenarios, bullish case scenarios, in regards to how the inflation data could come out tomorrow and then heading into Wednesday and Thursday. And then obviously, of course, we'll hit it on the head and end the call with a simple price analytical update on XRP, total cryptocurrency market cap, Ethereum, and Bitcoin. All right. So with that being said, just taking a look back at last week, going to our Friday report from last week, a lot of the retail-based community on the internet thought that the markets rallied because of some, Rippleverse SEC case ending for the first time ever in the past 5 years. We here in this community are much more intellectually inclined than that. And we actually understand fundamental drivers, things that keep risk assets supported, how the markets price things in ahead of time. And so some of the key drivers of last week's rally were we had dovish leaning Fed comments, leading to an increased probability of Fed rate cuts. We had weaker U.S. unemployment and PMI data pointing to economic softening in the United States, weakening the dollar, and again, increasing those rate cut odds later on this year. We had strong U.S. corporate earnings, especially in tech and semiconductors, so we had a strong rally in stocks. We had continued hopes for a Russia-Ukraine ceasefire deal as Trump and Putin prepared to meet later on this week on Friday, I believe August 15th. And then we also had an improving tone in the U.S.-China trade relations. Couple that with a weaker U.S. dollar, this created a positive backdrop for crypto. We also had some positive things signed into fruition with the executive order from Trump allowing crypto and 401ks. We had the SEC come out and provide verbal clarity on not only staking, but also liquid staking and the rewards that we get from liquid staking not classified as security. So there was a bunch of positivity in the fundamental and regulatory backdrop last week that led to the rally in crypto. Now, that rally continued over the weekend as we had dovish Fed speakers on Saturday talk. You can see here, this is just a report from CNBC mentioning a Fed speaker continuing their dovish remarks on Saturday. So that rally continued into the weekend, as I mentioned in that Friday report. As long as nothing changes the narrative heading into the weekend, then the market's usually going to gravitate towards whatever narrative ended the week with, all right? Whatever narrative it ended the week with. So if the narrative was risk on heading into the weekend, as long as nothing changes that fundamental backdrop via geopolitical tensions or, any tariff announcements, which we did not see this weekend, then the market's going to most likely continue on with that sentiment. And that's exactly what we saw, right? We saw a historic moment in trading view in the total cryptocurrency market cap, with the total cryptocurrency market cap on TradingView reaching $4 trillion for the first time ever. Now, give or take what platform you're looking at, CoinGecko, CoinMarketCap, some of those platforms read a higher market cap than TradingView. That's understandable. I'm just specifically talking about historical price action that we can visually see. So that was a great moment to live through. So the question is now, throughout the remainder of this week, in altcoins and Bitcoin, the total cryptocurrency market cap, and especially in other risk assets like equities, does this rally continue? Do we continue to see data that supports an increased probability of rate cut odds? Do we continue to see dovish Fed speakers? Do we continue to see positive rhetoric and sentiments around geopolitical tensions and tariff implications that support a continuation in the risk tone that we've seen in recent weeks? Or do we see the inverse of that? And do we see a pullback scenario take place, some profit taking unfold? And do we see a more risk off sentiment this week. All right, so that's what I really want to thoroughly break down for you guys in this particular fundamental video. I'll leave the floor open for questions after we get done for anybody that has open rhetoric, their own personal opinion that they want to bring to the table, or just openly talk and ask questions about what I break down for you guys. So let's get started. As always, I just want to reiterate that all of the things that we're going to discuss in terms of the fundamentals that I'm going to read for you guys today, showing you all that we're always ahead of the curve here at CYPRX. You can see in our report from August 8th, we had been talking about this already. So hopefully you guys have read this report from August 8th, which was last Friday, where I mentioned what to watch next week. Okay. Where we talked about the inflationary data coming up. We talked about the possibility of a more hawkish leaning Bank of Japan. We talked about a bullish scenario and a bearish scenario here in these little tiny breakdowns, just giving you guys some key bullet points. So really now I want to read through all of these fundamentals that I read this rising that are going to kind of paint that picture on where we're currently at and what could possibly unfold this week that will lead us into these outcomes. All right. The only thing that I do not have on this breakdown in thorough detail right now is the Japan data that we're set to get this week. So let's just take a look at the calendar this week. In terms of scheduled data, we have US inflationary figures on Tuesday and Thursday with the core CPI and PPI data. On Thursday, we also have key labor market figures to be mindful of with the unemployment claims. And then on Friday, we have core retail sales, Empire State Manufacturing Index figures, and we have the consumer sentiment and inflation expectations. All sprinkled throughout the week, we also have a whole bunch of different Fed speakers that we need to be mindful of surrounding their tone, whether they lean more dovish or hawkish. And then outside of the United States, our primary focus here in this community has been the positioning of the Central Bank of Japan or the Bank of Japan. All right. And so this week we have some key data on the Japanese front that could sway the sentiment and the rhetoric from the Bank of Japan, considering that their key focus has been on pretty much the same thing as the Fed, economic strength, inflation data, right? And the possible tariff effect that we could see later on this year on their economy and inflation. So this week we have Japanese PPI figures. So we do have some Japanese inflation. And we also have some Japan GDP figures, right? You can see down here on Thursday, we get a GDP print from the Japanese front. So throughout the week, as we get closer to those reports, I will try to break down those for you guys in the fundamental backdrop and the report for you guys. But just be mindful, any inflation data or any stronger economic data that supports the prospects of a Bank of Japan rate hike, we obviously, of course, know could lead to a stronger yen. Stronger yen inherently could obviously, of course, excessive strength in the yen could lead to unwinding of yen carry trades. And we know there's a lot of leverage, right now in risk assets surrounding individuals that borrowed cheap yen to hedge against the depreciating currency and put that into riskier assets like stocks and crypto. So that could always be a catalyst that unfolds that leads to a temporary risk off sentiment that could linger in the markets and still does linger in the markets as of time of recording this video. So I just wanted to, again, bring that to your guys' attention. That's not what we're going to focus on in this video breakdown, but still something to be mindful of this week. So right now, taking a look at some of these reports. So I'm just going to read through all my highlights on each of these fundamental reports that I read this rising. And it talks about here from market-to-market.com, the economic diary is light today, but tomorrow sees the July CPI. The median forecast in Bloomberg survey expects the third consecutive month increases in headline in core rates. The pendulum has swung hard, and now the Fed funds futures are discounting two cuts and about a 40% chance of a third in the last three FOMC meetings of this year. Now, this is a rhetorical question. Just answer it in the back of your head. You don't need to speak out loud, but why do you guys think I highlighted this as a key focal point in everything that this report says? Look at all the fluff in this report. This is the only thing that I highlighted. It's because it gives us an insight into what the market is perceiving the rate cut trajectory to be. And so we know that if this changes, i.e., it becomes stronger, meaning that the data supports an increased probability of the odds of rate cuts happening later this year, this could support risk assets. And inversely, if the data comes out or Fed rhetoric comes out or sentiment in terms of reactive headlines around tariffs or geopolitical tensions come out that change this current narrative of what the market is pricing in for or the rate cut trajectory, right? And we see the rate cut trajectory lower, i.e., the odds of a September and later on this year rate cuts taking place lower, then we know that that could weigh on risk sentiment, considering that the market has aggressively been pricing in increased probability of rate cuts later on this year, and that has been a key driver in global risk assets. Okay, so that is why I highlighted that from this report. Again, just something to be mindful of. The reason why I like reading these reports out for you guys instead of reading my typed out reports is so that way you can see what I highlight in these reports, so you can get a gist into how I think about these reports, what I portray to you guys, and how I digest this information. So this is a report from ETFtrends.com, and it goes on to read, really great takeaway from this report. The total non-farm payrolls rose by 73,000, visibly below the consensus estimate of 104,000. This was again last week. However, the bigger news is the fact that the prior 2 months were revised down by a combined 258,000, the largest non-COVID related downward revision since 1979, which is why the market was aggressively pricing in increased rate cut probability. As a result, the 3 month moving average for payrolls plummeted to only 35,000 in July. Powell's new favorite indicator, this is important, says it's the unemployment rate, and that ticked up by 0.1 to a still low 4.2%, which was in line with expectations. While we still have another employment report and 2 more months worth of inflation data before the September FOMC meeting, does anybody remember what we talked about in a report a couple of weeks ago where we broke down the landscape for August and September and we thoroughly went through all the reports that we have upcoming? Now we can see retail reports talking about the same stuff that we were talking about in this community weeks ago, right? So we still have another employment report and 2 more months worth of inflation data before the September FOMC meeting. Today's jobs report changes the labor market backdrop that Powell has been basing his policy decisions on. Jackson Hole later this month, which we know is on August 22nd, will provide the opportunity to change forward guidance for Powell. On its own, this jobs report puts a September rate cut in play. What happens, though, if upcoming inflation reports are elevated and show more tariff pass-through effects? That's the potential conundrum. Respectively, on Fed repricing following Powell's somewhat hawkish FOMC press later this week. So it says, needless to say, the Treasury market rallied with the 2-year and 10-year yields falling more than 20 basis points. Respectively, on the Fed repricing following Powell's somewhat hawkish FOMC press later or last week. However, a further rally, especially for the 10-year, is dependent on upcoming inflation data, such as the CPI report tomorrow. So I highlighted that because it tells us that if we want to see a sustainable rally in risk assets, we want to see a sustainable rally in the current sentiment that we've seen this past week, we need to see more supportive data. All right. Coming over here. So first, the July CPI, it is expected to come in firmer at 2.8% from 2.7% previous, and for the headline figure at 3.0% from a previous reading of 2.9% for the core. It would be the third consecutive increase in the headline and core rates. This may see the market rethink about the likelihood of a third cut this year. So I highlighted that in red because if we were to see elevated inflation and we were to see the market start to price out a high probability of rate cuts later on this year or even in September, that could again lead to a market correction. This was a very interesting report, okay, from Yahoo Finance, and it goes on to read, starting at the top. With the markets now pricing in, this is important, several interest rate cuts from the Federal Reserve this year, Tuesday's Consumer Price Index inflation reading will headline the week of economic news. Investors will also be closely tracking updates on wholesale inflation, retail sales, and consumer sentiment. So again, reiterating what I've already mentioned to you guys in previous reports from August 8th, what we need to be mindful of this upcoming week. A quiet week of economic data did little to change the recent shift in the economic narrative. Fears of a slowing labor market are driving investors to bet the Federal Reserve will cut interest rates by at least half a percentage point this year. And the nomination of Stephen Myron, current chair of the President Council of Economic Advisors, set to replace the Federal Reserve Governor Adrian Kugler, is only fueling predictions that the central bank will be cutting interest rates soon. Wall Street economists expect headline inflation to rise 2.8% annually in July, which is an increase from the 2.7% seen in June. On a core basis, which strips out food and energy prices, CPI is expected to have risen to 3% over the last year in July, up from the 2.9% increase seen in June. Monthly core price increases are expected to clock in at 0.3%, which is above the 0.2% seen the month prior. UBS, which is a bank, senior economist Alan Dietmeister wrote in a note to clients that tariffs are driving the acceleration in inflation. And July's data will bring the start of a several month uptrend. This is not a good thing. Why? Because this could lead to a pullback in risk assets if we were to see this uptrend in inflation start to unfold. Dietmeister projects core CPI will move from 2.9% in June up to 3.5% by the end of the year. That would be something very interesting to watch unfold, right? Richard Bernstein, an advisor and CEO of this organization, Bernstein Advisors, told Yahoo Finance that there are usually two things that can bring a speculative surge in markets to an end. So I highlighted this in red for you guys. One is that the Fed is forced to hike interest rates as inflation pushes higher. This, Bernstein said, makes the cost of leverage both for investors and companies higher, limiting liquidity in markets. This would be a worst case scenario. This would be horrible. If we did see higher inflation, i.e., this UBS prediction of higher inflation towards the year's end coming to fruition, and the Fed was forced to hike rates, right? And a stagflationary environment where we see economic conditions continue to worsen in the labor market while inflation continues to spiral out of control or remain sticky and troublesome, this would not be good for risk assets. The other scenario is when the Fed cuts interest rates as the economy is slowing rapidly and appears headed towards a recession. There's that key vocabulary word. We know that recessionary fears, even under the continued prospects of interest rate cuts from the Fed, or even if the Fed cuts interest rates, serious deterioration in economic activity, including the labor market, can lead to more demand in what? Safe haven assets. And we know increased demand temporarily for safe haven assets usually tends to reflect itself in weakening in risk assets like crypto and stocks. Again, temporarily, as the market reprices all that information in the moment. When you get a combination, people stop speculating because they have to buy bread and groceries and things like that, Bernstein said. They're not speculating on Bitcoin, they need bread. To Bernstein, this puts the Fed's current quandary at the center of attention for investors wondering how much further the market can balloon higher. What the markets have to look at very carefully here is the dilemma that the Fed is faced with, Bernstein wrote. Are the employment numbers weak enough so the Fed can cut rates, but not weak enough to cause a recession so people start shifting from Bitcoin to bread? That's the dilemma that the Fed is in right now. So I wanted to read that to you guys again because it gives those if-then scenarios where if we do see higher inflation and we see the Fed hold interest rates higher for longer, or even worst case scenario, have to hike rates to keep inflation tamed in control, that could be a very bad scenario for risk assets temporarily, right? We already know the underlying fundamentals in crypto are excessively bullish. After a pullback of this scale, the rally would likely continue into 2026. However, it's something that we need to be mindful of moving forward, and it's not a scenario that we can just take off the table and not expect to take place if things did continue to unfold in this manner, right? And then the second thing he was talking about is recessionary fears. D'Angelo, hold your question to the end, brother, so I can just continue to flow, but I see your hand up. All right. And we'll come back to this report so that way you can ask your question on this specific report, right? And then the second thing is the scenario where the Fed does cut rates, right? But again, the economic data leads investors to fear increased probability of recession or that we are in a recession, which usually tends to create safe haven demand in the moment, right? So we'll probably see gold balloon higher, and we'll see other safe haven assets balloon higher as well. Most likely see some dollar weakening. All right. To continue, another report. This is from August 8th last week. Just to read some of my highlights, it says, this has important implications for the Fed. If economic growth slows because of a declining labor force rather than weak demand, the Fed may not respond with rate cuts, especially if inflation remains elevated. The bottom line is here, markets right now seem too dovish on rate cuts. While a single rate cut in September cannot be ruled out, we think that the market is overestimating, I highlighted that in red, how much easing will follow. If you guys remember in previous Zoom calls, I've told you guys that this has happened so many times. Well, the market, because of its ability to price things in ahead of time, sometimes gets way ahead of itself. And so if recently we've seen the rally in risk assets, primarily because of interest rate cuts being priced in, but then those interest rate cuts, because of upcoming data coming out, being pushed back, and the market has to price that out, it's most likely going to lead to a pullback, right? Inflation still remains well above the Fed's 2% target, and the full inflationary effects of higher tariffs have yet to be felt. We don't know if we're going to see higher inflation because of the current tariff implications. That's what the market's speculating on right now. So unless there is a significant unexpected jump in the unemployment rate, which we currently don't expect, the Fed is unlikely to deliver 5 cuts over the next 2 years. So I highlighted all of that in this report. As we continue, this is a report from Reuters, and it goes on to read, cooling inflation could cement bets for a cut next month. But if signs emerge that US President Donald Trump's tariffs are fueling price rises, that might keep the Fed on hold for now. It is important to note ahead of tomorrow's data that the bar for a hawkish surprise is a lot higher. Okay, so keep that in mind. Said Francesco Paslo, an FX strategist at ING. ING is one of those banks that we like to pay attention to because they're usually right. Honest to God, I don't think I've ever written or read a report to you guys from ING that has been wrong. They're pretty spot on with their analysis. So keep that in mind that they're projecting a hawkish surprise this week, which we know would likely strengthen the dollar and again, deteriorate those rate cut bets, leading to some type of pullback in risk assets. To what degree, again, we don't have a crystal ball, but we can assume based off of that environment, it would likely lead to some type of temporary sell pressure in risk assets intraday, right? Money market traders are pricing in right now around a 90% chance of a rate cut next month, while 58 basis points of easing are priced in by year end, implying 2 quarter-point cuts and around 1 in 3 chance of a cut or a third cut later this year. The reason why I highlighted that again is because it gives us insights into what the market is pricing in. And so if we see these odds decrease, so let's say, for example, the inflation data comes out tomorrow and the odds of a September rate cut drop substantially from 90% down to like 60% or 70%, most likely we're going to see that reflected in price, right? We're going to see the market price that out, the odds of rate cuts, which have been driving markets higher, and we're going to see the market reprice that information in. Okay, so just be mindful of that. Trade talks were also in focus as Trump's August 12th deadline for a deal between the United States and between the United States and China neared, particularly on the chip policy. So I highlighted that because it gives us insights into dates that we have for deadlines around tariff implications. And now here, this is very important because it says the market has fully priced in the idea that we're going to get a trade extension between US and China, said Chris Weston, head of research at Pepperstone Group, adding that another 90-day tariff truce will most likely be the outcome. So that means if we do see, in terms of these China-US announcements tomorrow, them announce that they're going to just extend the tariffs. We don't see any necessarily excessive positive announcement. We just see that they're going to extend the tariffs. Well, the market has already priced in that positive news. And so again, it's going to lead to a buy the rumor, sell the news event, where because the market's already priced in this positive news between the US and China that they're going to extend to continue to work on trade negotiations, it's most likely going to either have a muted impact on risk assets or again lead to some slight profit taking, unless there's an inverse scenario that happens and we get a net new bullish announcement that the market has not priced in. Like they come to some trade agreement that's announced, they don't extend the tariff deadline, they high five each other and solidify lower tariffs, right? That clearly has not been priced into the market and could propel markets higher. So we can't rule that out as a possibility, but again, it's highly unlikely, right? As we continue, you can see here some other dates. August 15th, Trump, the meeting between myself and President Putin will take place in Alaska on August 15th. That is Friday. All right. So another key date that we have to be mindful of as we are on the precipice of a possible ceasefire agreement between Russia and Ukraine with the United States involvement in that. Then here you can see Trump is reportedly nearing a face-to-face meeting with President Putin. I highlighted that in one of the reports from Yahoo Finance, which we now know is going to be on Friday. But then here at the bottom, this is another reactive headline that we need to be mindful of this week, as this says Trump is also preparing for a ruling in a court case that will decide on his authority to impose many of his sweeping tariffs. I highlighted this because in previous fundamental reports and calls that we've done, one of the things that led to a rally in risk assets was when Congress pushed back on Trump's ability to impose these tariffs and pretty much said that Trump cannot impose these tariffs, excuse me, which we know that if the court rules that Trump cannot impose these tariffs, that means that all these high tariffs that people are expecting, economists are expecting, will lead to higher inflation. That sentiment will likely change to some degree and could propel risk assets further. Inversely, if the court announces that Trump is allowed to impose his tariffs and the tariffs stand at current rates, then obviously, of course, this could probably lead to dampening market sentiment, right? As it would give Trump full control to continue doing what he's doing, manipulating the markets with his words and his comments and his tariff implications. Okay. So I don't know how the markets honestly would react to this news, but it's just something that I wanted to bring to your attention that will likely lead to some volatility this week in terms of reactive headlines that we need to be mindful of. Okay. Moving on here from this report from CNBC talking about the US China trade relations. I will drop this in the chat. It's very thorough. I did not read the entire thing, but one thing that I did take away from the portion that I did read is it says US negotiators have put the ball in President Donald Trump's court on prolonging the tariff truce. Trump so far has offered little indication on whether he will go for an extension that has stoked concerns that tensions between the world's two largest economies could rise again. So if tomorrow we don't see any news on a tariff extension between China and the United States, remember, anything that the market perceives as uncertain intraday can create more demand for safe haven assets. So if tomorrow, under the lingering 12th deadline announcement, we don't see anything come into fruition and it just increases uncertainty in the markets, we know intraday it's most likely going to lead to some more profit taking. If we saw that uncertainty coupled with higher inflation, then that could again propel safe haven demand higher and lead to weakening in risk assets. So all of these scenarios, again, just keeping in mind and putting it on the back of your minds moving forward. There was an article around Zelensky's whole opinion on what's taking place between European leaders, the United States and Russia. I will also drop this one in the chat for you guys as it does give some insights into some key dates coming up. All right. Outside of that, all right, those are all the reports that I've read up until today, which will lead us into these scenarios. All right. So specifically just focusing on inflation scenarios. This has nothing to do with increased tensions between geotensions between Russia, Ukraine, or anything related to the Middle East. And then this also has nothing to do with the upcoming tariff announcement. So just be mindful, any headwinds, a headwind being something that usually has a negative impact on risk assets. So any headwinds in terms of geopolitical announcements or tariffs that the market perceives as uncertain or negative could weigh on risk assets, regardless of how the inflation data comes out. So regardless of how, let's say, for example, in one of these scenarios, I talk about a surprise to the downside inflation that propels the odds of a rate cut higher, supporting risk assets. Even if that were to happen, if the next day following that announcement, we see China and the United States increasing tariffs, arguing with each other over tariffs, creating more uncertainty in the market, that could outweigh the inflation, right? That could outweigh the market's pricing in the rate cuts, and that could lead to an uncertain condition. And that could obviously, of course, weigh on risk assets. So just remember that the reactive headlines, we still need to be mindful of as we are in a very reactive environment. Okay. And then obviously, of course, inverse, even if we saw higher inflation, but we saw a ceasefire announcement and we saw two major jurisdictions like China and the United States high-fiving each other and coming to some trade negotiation that the market is not priced in. Even if we were to see higher inflation, the market could rally off of that optimism just based off of those headline announcements. All right, so just be mindful of that. Let's go over these scenarios real fast. Take a look at price action, then I'll open the floor for questions. I know D'Angelo had one, and then anybody else that has questions. So let's just look at these scenarios, okay? So, worst case scenario, these are my personal forward outlooks. Again, you guys can create and draft your own. This is what I personally perceive to be, and I'll go over what I think is going to happen, okay? What I think is going to happen is number two, all right? So, worst case scenario. This will be a bearish case scenario where tomorrow we see an intraday pullback in risk assets and we see increased demand for safe haven assets like the dollar and maybe other currencies like gold and yen. All right. So the outcome, inflation comes in higher and remains elevated. This would dampen the probability of September rate cuts and reduce the expectations of total cuts later this year. Market reaction would likely be a sharp correction in the recent bullish rally. What I think is going to happen tomorrow is the number two scenario that I've written out for you guys, which is going to be a choppy continuation. So tomorrow, if inflation prints higher, which I think it is, I think that what the market's expecting right now is what's going to come out. So if the market's expecting a slight 0.1% increase in both the core month over month and year over year CPI data, I think that that's what's going to happen. But I don't think it's going to be high enough to significantly reduce the rate cut odds. So tomorrow, if the inflation does come out slightly higher, and the odds right now are at 90% probability of rate cuts in September, I think that those odds slightly dampen to like 80%, but the market still holds on to the rate cut narrative. So what this would likely lead to is a temporary pullback and or choppy price action as the market digests this data. But then the market awaits further data that we're set to get later this week before the markets aggressively lean one way or the other. The rate cut narrative would likely remain intact, albeit the odds would slightly dampen and the markets would continue to find some support. That's what I think is going to happen tomorrow. We might see some slight profit taking or some slight choppy price action. I think that the inflation print is going to show a slight higher reading, but the market's going to perceive that as not high enough to significantly reduce the rate cut odds. So this is what I'm betting on tomorrow. And then the market will likely wait for the PPI data and the unemployment figures and the consumer sentiment and retail sales later this week, along with the Fed rhetoric. That's what I think is going to happen. The market's going to wait for more data before it makes some massive indecisive move. All right. Number three, because again, I could be wrong. So we need to prepare ourselves for those if-then scenarios. So number three scenario I have written for you guys is a bullish trap where smart money repositions itself considering what's being priced into the market right now, which we know, reading these reports, the market right now is most likely overestimating how much the Fed will ease, or the market right now is also pricing in aggressively rate cuts, right? So you can see, remember we read that the market's already pricing in rate cuts. And so what could happen tomorrow is this scenario. Inflation comes out lower than expected, but since rate cuts are already priced in, the market uses the news for a pullback. So again, a buy the rumor, sell the news event where uninformed traders get trapped in buy positions at highs during the drop, while the smart money buys at a discount to continue the rally. So everybody that is uninformed in the markets that doesn't know that the markets have likely already priced this scenario in, where if inflation does come out lower, it surprises to the downside. Well, that would increase the odds of rate cuts, right? But the market has already been pricing in a high probability of rate cuts at 90% plus. So what smart money could do is trap uninformed investors thinking that lower inflation readings will continue the markets higher. They could trap them in buy positions at highs, sell their positions to reestablish at discounted prices. That could be a scenario that could unfold tomorrow as well. And then we could have a rainbow scenario where we do see a strong bullish continuation, which is what I hope happens, right? Because just like you guys, I want to see continued price appreciation in my portfolio. But if I'm being completely honest, it's the least likely scenario, but still possible. And that would be a strong bullish continuation, an unpriced in surprise and downside inflationary figures. So if we saw inflation come out lower than the market's expecting and lower than previous readings, it would likely surprise the market. The market maybe have not priced that in yet. The outcome to this, inflation surprises to the downside that was not priced in. It reinforces dollar weakness and the markets rally strongly without a significant pullback. Again, I personally don't see that scenario happening. I think that it's either going to be number two or number three that happens, right? That's my personal opinion. So taking a look real fast at the current price action. So scenario number one, a scenario where we get worst case bearish scenario, then likely what that price action in the total cryptocurrency market cap, we'll talk about XRP next, would look something like this. Right now, we're seeing some slight profit taking as the market, let me change this real fast. We're seeing some slight profit taking as the market reached a new all-time high. And under a bearish scenario tomorrow, we could see a failure by buyers to break higher, sellers starting to show their hand, and increased sell pressure after that event taking place. Or we could just see continued sell pressure from where we currently stand, leading to a deep retracement from last week's bullish rally. On XRP, the likely scenario under those bearish case scenarios is same thing. You can see here that we've seen sell pressure from these three focal points: sellers, sellers, and sellers. And now you can also see sellers showing their hand again, defending against buyers. In a bearish scenario tomorrow, buyers might make another attempt to push higher, fail at that attempt, sellers show their hand, turn this into resistance, and we start to see the retracement unfold. Or we continue down from where we currently stand to revisit discounted positions. That would be what price action likely looks like tomorrow under these scenarios. The neutral to slightly bullish choppy continuation. That would be a scenario where inflation prints higher, but not enough to significantly reduce the rate cut odds. A temporary pullback and choppy price action as the markets digest the data and await for further data later this week before the markets aggressively lean one way or the other. The rate cut narrative remains intact and markets continue to find some support. The likely scenario tomorrow in that case would be some consolidation at these highs, no significant sell-off, and just sideways price action across the board for XRP, the total cryptocurrency market cap, ETH, and Bitcoin. So no significant move higher and no significant move lower, and instead just choppy price action. Number three, bullish trap scenario. Inflation comes in lower than expected, but since the rate cuts are already priced in, the market uses this news for a pullback. Uninformed traders get trapped in buy positions, while smart money repositions at a discount to continue the rally higher. That would look something like this. On XRP, sell pressure temporarily, markets find some support, and the market continues higher. As for the last scenario, the scenario that I hope for, but is the least likely scenario, and that is a strong bullish continuation, an inflation surprise to the downside that was not priced in, that reinforces dollar weakness. The markets continue to rally strongly without a significant pullback, which is what I personally hope happens, right? So now taking a look at some upside targets and some downside targets on XRP specifically. If we do see the number four scenario unfold and we can break above this resistance level here where we can clearly see sellers showing their hand and have done so before, we can break above this and create support. That's going to open the door for our next sell delta at $3.59. Above $3.59, we still have the sell deltas resting at $3.82 that we have yet to see come into fruition, as XRP's price rally in mid-July stalled out just underneath of those sell deltas. So we can assume most likely that if those sell deltas are reached under an excessively bullish environment, when we break above $3.59 and we come into 382, we have aggressive sellers sitting here in this area with sell orders. We're most likely going to see or be met with some resistance and some profit taking. So our targets to the upside, if we do see an aggressive bullish move or an increased risk on sentiment in the near term, are going to be $3.59 and $3.82. My highest targets on XRP still stand, as Scalper did update these levels earlier today in the Discord. Still stand at $4.44 to $5.17 as my highest 2025 targets for XRP. But for now, taking this level by level. 359 first, 382 next. On XRP for now, our next downside targets for possible re-implementation of capital comes in at 296 as a buy delta under worsening conditions. For example, this scenario here, worst case scenario that could take place is an upside surprise to inflation that pushes back on those rate cut odds and puts sell pressure on risk assets. That would open the door for a pullback in XRP down to 296. This to me right now kind of looks unlikely, this price action, but it's possible. And if we break 296, that'll open the door for a revisitation of 282. We'll stop there though. So right now to the downside, the most immediate bearish targets are 296 on XRP and 282. We'll have another Zoom call most likely before those targets are met. Outside of that, that's all that I have for you guys today. Hopefully that painted the landscape very clearly for you guys, gave you guys some forward-looking scenarios as we roll into tomorrow's CPI data. Keep in mind that we do have some reactive headlines coupled with Fed speakers sprinkled throughout the week. So, be mindful of their comments, be mindful of whether they lean more hawkish or dovish, and understand what that can do to price action as well. But outside of that, that is the forward-looking outlook for this week and what we need to be mindful of. I'll leave the floor open for questions, starting with D'Angelo. Go ahead, brother. Let's revisit this report. Which one was it? This one here.
Do you think, bro, given the underlying tech fundamentals within the market, that even if